Good evening, everybody. Thank you again for joining us this evening. While we wait for a few people to log on, we've got a lot of people joining us this evening. I thought I would just introduce us. A lot of the agents are back in business and we're back doing viewings out there. And I must say there's quite a bit of activity. There's a lot of viewings, obviously, with the safety regulations in place and so on. What I have noticed is that it's helped us deal with serious sellers and serious buyers. So a lot of activity, a lot of questions that have been proposed through to us. And so this evening, we've got Jaco and Schalk that are going to be leading the webinar this evening. First of all, let me say we're not financial advisors. This is just giving you answers to some of the questions that we've been asked. The webinar this evening is now a good time to fix the rate of your home loan. And so like I said, we've got Schalk and Jaco with us this evening. Jaco Janse van Rensburg started off in the property business as a sectional title agent, so he's no stranger to the property business. He then moved over to the financial side, and for the last 10 years, along with his assistant, has been the leading bond originator for the Rawson Group. So we're very, very fortunate to have Jaco part of our team. I will tell you this, that I have had the privilege of doing one of two deals with Jaco. He doesn't know this, but I call him the magician because some of the rates that he gets and some of the bonds that he gets approved are just phenomenal. So like I said, we're very grateful to have Jaco with us in this team. Along with Jaco, we've got Schalk van Merwe. As you know, Schalk heads up our Somerset West, Gordons Bay, Strand and Grabo, and not only sales, but rentals and commercial as well. And between Schalk and Jaco, there's a wealth of knowledge and a wealth of information that we're going to be getting this evening. I will say at the bottom of your screen, there is a little icon. So if you have any questions, please put them through with a telephone number. We do have agents on call, so somebody will contact you, if not this evening, possibly tomorrow. Again, put your questions through. We'll try and get through some of those questions if we have time a little at the end of this webinar. And with that, I'd just like to say thank you very much for joining us, and over to Schalk.
Good evening, and thank you, Roger, for the introduction. Jaco, thank you for joining us.
Good evening. Hi, Schalk.
We are busy, and the market is busy. Jaco, from our side, obviously, we are usually the first ones to lead the activity on your side. Given the activity and the on property viewings at the moment, are you guys busy with bond applications? I see there was an article this week or last week in the papers or online about a 40% increase in bond application with first-time buyers. What are you experiencing on your side at the moment?
Yes, Schalk, definitely. We also have a huge influx of applications that's come in. We started getting busy about 3-4 weeks ago, and at the moment we're very, very busy. We've noticed the segment between below 0 and 2.5 million. We've got a huge influx of applications that has come through. Above 3 million is a bit quieter, but anything below 2.5 is extremely busy. We're getting lots and lots of inquiries as well from first-time buyers that's coming through, as well as clients that is currently renting properties that are looking to buy property, 10 to 1 the ones they're renting, or similar properties because they can afford to do so at the moment.
Jaco, while I get the presentation ready, can you maybe just give us an idea of the percentage of buyers being investors, first-time buyers, and people downgrading or upgrading? What's the percentage at the moment between those three categories while I get the presentation ready for us?
Right. Investors, we've got quite a lot, but I would say our biggest market segment at the moment is first-time buyers. If I have to use a percentage, I would say at least 50 to 60% are first-time buyers. Then we do have our investors still that's also looking at purchasing property because of the huge interest rate gap between what it was beginning of the year and what it is now. There's a lot of spare surplus clients have at the end of the day, and that means clients can afford to buy investment properties now again, which was a bit of a hamper earlier on in the year and the end of last year.
Great, thank you, Jaco. So let's go into our presentation tonight to hopefully answer this question. The debate about whether or not to fix the interest rate on your home loan has been reignited by 3 cuts in response to the coronavirus outbreak. This has brought interest rates to the lowest point in nearly half a century. It's important to remember that each person's financial position is different, and to take this into account when you do make this decision. And that's why I introduce you tonight to Jaco to guide you on this journey. So tonight, as you could potentially gather from our presentation, there's no simple answer to the question of fixing or not fixing the interest rate on your home loan. But there's some very important factors to take into account whenever you consider this. So let's go into our presentation. And I first want to just tonight give you an idea of where we came from with interest rates. The repo interest rate in 1998 was as high as 24%, moving down in 2008 without recession, 2008-2009 recession down to 12%. Bear in mind this is the repo interest rate, and at the moment we're sitting on 3.75%, which is the lowest it has been in more than a decade, more than 50 years.
Yeah.
So what I would just like to show you what this impact has been on a R1 million property on a bond installment over the last 22 years. In 1998, a bond of 1 million rand would have cost you 23,000 rand. That was at a prime interest rate of 27.5%. In 2008, a R1 million bond would have cost you on monthly installments 13,500 rand at a prime interest rate of 15.5%. And today it's at 7,900 rand. And this is a saving grace for the property market and I think our economy, which makes it really affordable for people to get into the property market. This is an opportunity not to be missed. And looking at property over the last how many years, we've seen that it has not lost value to what we've seen on the stock market and can be seen as a stable investment if you look at it over a period of more than 5 years. Now, going into the next slide, I would like to ask Jaco just to give us more information or clarity on what I've just explained. I've given interest rates of repo and the prime interest rate. Jaco, would you just guide us into the difference between the repo interest rate and the prime interest rate?
Definitely, yes. Repo interest rate is the rate at which the Reserve Bank lends money to the major financial institutions. So it's normally 3.5 below your prime interest rate. So repo rate at the moment is 3.75. That's, as I say, the rate the Reserve Bank lends the money, and then the banks normally add then the 3.5% on top of that to get to a prime lending rate. And that is the rate at which they decide then to lend money out to clients. Now, it's then the bank's decision if they want to give you above or below that prime lending rate, depending on your risk profile that the banks look at when they assess your application.
Jaco, now, in your experience at the moment, what are you finding with bond applications? Are the banks adding to the 7.2.5%? Are they taking off like in the past where we get -2? What is your, over the last 2-3 months, your feedback being from the bank on what rates has been achieved?
The banks, they look at the risk profile. They're very risk dependent at the moment. To answer your question, we've had interest rates coming through with prime being 7.25. I've had rates of 9.5%, which is way above prime, but it's because it was high risk customers. They were willing to give the bond, but it was a bit of a risk to the bank, so they lowered the interest rate. One client I managed to secure a loan for about 2 months ago was prime -2.1. Because she managed to put a big deposit down, good customer, she had an existing bond with the bank that was being cancelled. So there was a low risk factor and the bank did not want to lose her business. So they gave a prime -2.1. So we're getting huge fluctuation between the rates, but traditionally the average we're getting is about 0.5, 0.8 below prime. That is the average that we're getting for clients at the moment.
Okay, Jaco, you're using, you did just mention now putting a deposit down.
Yes.
You, just for our listeners tonight, that is definitely in your favor when it comes to bond application to get a better, a more favorable rate on your interest rate. Is that right?
100% true. That is the biggest factor the banks look at on the risk factor, is the size of the deposit. We've seen plenty of times where we receive 100% bond from the bank. It's at 7.5. The client puts a 20% deposit down, it drops down to into the 6. 6.8, 6.75. So it's a huge difference if you put a big deposit down, and they work in increments of 10% and then 5%. So it doesn't help to put just an amount down. It needs to be 10% or 15 or 20% of the purchase price, and then it makes a big difference on your rate. Yes.
Great. I would also like to just to add to this to say Jaco is available. Should you want to know what your credit profile is look like at the moment, to give you an idea of how you positioned in terms of the attractiveness of giving you a favorable rate. So if you are interested, Jaco is available to help you with that, and you can contact him afterwards anytime. Quick a slide to show you what the bond installment is on a 1 million rand property at what it was in the beginning of the year, 1 January 2020. Over a 20-year period, your bond would have been on a 1 million rand property, 9,650. Today, your bond installment on a 1 million rand property at 7.25% over 20 years is 7,900 rand, a saving of more than 2,000 rand. What I would like to do now is just to give you an idea of the affordability to be able to afford a 1 million rand property. So should you be in the market to purchase a 1 million rand property, affordability earlier this year was you had to earn a joint gross income of 32,000 rand to afford the installment of 9,650. The option is also to finance your bond over 25 or 30 years. Might not be the best financial decision, but to get your foot in the door, that's also available. But I would like to focus tonight on the 20 years. And at the moment, if we look at the current interest rate, affordability has come down by nearly 8,000 rand from 32,000 rand joint income. Now, if you earn close or in the region of 26,000 rand, you are now in the market to afford a bond of 1 million rand. So came down from 32,000 to 26,000. So this is the reason why we've seen a 40% increase in bond applications over the last few months. Very attractive to first-time buyers and current tenants to purchase where they actually rent. I would like to just point out that the option is there for you to either use this as a backdoor, should you be financially under pressure, to extend your bond from 20 years to 30 years, which will make a big difference from 26,000 rand to 22,000 rand a month. Obviously, paying more interest and taking much longer to pay back your loan. But that is a backdoor should you need that. Or also, if you just would like to get your foot in the door, that is obviously another option to use. Bear in mind, that is the maximum term available to finance your property at. So there's no backdoor if you do consider the 30-year bond installment. Jaco, just a question. On a 30-year bond installment, would the banks again look at that a more favorable interest rate, or doesn't that play a role in determining the interest rate that they charge?
Interesting enough, Schalk, some of the banks, one or two of them, gives you a worse interest rate over 30 years. Our arguments were that it should be a lower interest rate because your installment is lower, therefore your risk is lower, and then the interest rate should be better. But some of the banks actually drops your interest or increases your interest rate by 0.15 or 0.35% sometimes for clients if you take it over a 30-year term. So they do give it, but it's sometimes a bit more expensive to take it over 30 years.
Good. Thank you for that, Jaco. The next slide I would like to ask Jaco, just to give us more clarity before we go into the factors determining whether you should be fixing or should not be fixing your interest rate. Jaco, just give us an idea of exactly what is the difference between variable and a fixed interest rate. I know to some of our listeners tonight that have bought property in abroad has seen interest rates or bonds on their properties where they've taken the interest-only option with no capital down payment. Unfortunately, that is not available in South Africa, and we do not have that product available. And I think, Jaco, given that that's not an option, let's go into the difference between variable and fixed interest rate.
But variable, that is where your rate will fluctuate with the prime or repo rate as it moves up and down. So as the Reserve Bank increases or decreases the repo rate, which then results in the banks increasing and decreasing the prime lending rate, that means your rate will then move up and down with those rates. You'll normally get a percentage above or below prime. Let's say you get prime minus 0.5 for argument's sake. That means your rate will always stay 0.5 below the prime rate as it moves up and down. And that is a variable rate, which means it varies, it moves up and down with prime. Fixed interest rate is where your rate is fixed for a certain time period. Now, normally it is between 1 to 5 years, depending on which bank it is, that you can fix your rate. And that means your rate will remain as is, the rate that you fix at for that period. If repo or prime rate moves up and down, your rate will remain the same. So the changing of the repo rate will have no effect on your interest rate. And it's normally slightly above the prime rate or the variable rate that you would have received, the fixed rate. It's only above, slightly above that.
Jaco, now we say here a period up to 5 years. So yes, we are saying to our listeners tonight that to fix your interest rate for 20 years, 25 or 30 years is not an option.
Correct. Yes, 5 years is the maximum term that the banks will fix the rates at the moment.
And maybe Jaco, just to get an idea, have you had this request being put forward in the last month or two from clients that they would like to fix interest rate, and they had any outcome from that yet?
Yes, we've had some feedback from the banks. Some clients have fixed their rates. Traditionally, Standard Bank, they've informed us they will fix the rates, some over 1 year term at prime rate 7.25, which is a very good offer. So some clients have decided to take that. Another client was offered a fixed rate of 0.14 above his variable rates from ABSA for a 1 year period, which the client also opted to take. So yes, lots of clients are starting to look at the fixed rate option. We always suggest to contact the branch once your bond is registered to find out what fixed rate are being offered, and then from there to make the decision. But yes, lots of clients are opting for fixed rates at the moment.
Right. As we move on to the next slide, I would like to ask our listeners tonight just to help us with a quick poll, which will be made available to you as well. After the poll, which will take not more than 2 minutes, we will continue with the presentation, giving you the factors to think about, to consider before you do fix your interest rate. So can I ask Megan just to put the poll up for us, please? Thank you for completing this, and this will be made available to you afterwards for general information. Thank you. Jaco, maybe while we wait for the listeners to complete, we have in our previous webinar discussed first-time buyers where they might have quite an outstanding credit card, they have got vehicle finance, they have a personal loan, and there's quite a few questions on that as well. You did confirm last time that having current debt does not impact your the ability to apply for a home loan as well. Is that right?
Correct, providing you don't have too much. But yes, it's actually good to have debt. It helps to show the banks that you are a good payer. So it creates a payment profile for you on the credit bureaus. It shows the bank that you are actually paying back, which then shows you're a low risk customer. And as you mentioned earlier on, your rate is determined by your risk profile. That risk profile will be positively influenced if you have contractual debt, which is a good thing. But I said earlier on, as long as you don't have too much debt, some of the banks also look at your contractual debt installments when they assess your affordability. And having too much contractual debt has got a negative influence on your application. So it's a good thing to have some debt, but not too much. So it's a very fine line you need to walk on that.
Thank you for that. Thank you for completing the poll. I'm going to end the poll now. And let's go into the factors determining. So Jaco, maybe take us through the factors one should think about before you consider fixing your interest rates.
Right. Market conditions, as you've got on the slide, there's a very important factor you need to keep in mind. At the moment, we are on a down cycle. We are very low in the cycle at the moment, which means it's very favorable to apply for debt because the interest rates are so low. Now, that is creating a domino effect. As I mentioned earlier on, below the 2.5 million purchase price bracket, we have a lot of activity at the moment in the market. I don't know, how do you see it, Schalk? How long we will still, that market conditions last below the 2.5, the busyness we've got below the 2.5 million? I don't know, what's your opinion on that one?
We are seeing definitely a huge demand in that price category. Given that tenants are now looking to purchase as well. I think that the activity will remain active and busy for at least, the next 6 months to a year. The question is whether people will see growth on the investments in the next year or two. And I think that was answered in the previous webinar where we said market conditions, given our low GDP growth at the moment and forecast for the next year or two, we will not see phenomenal growth on property prices in the next few years. So in that regard, properties are below 2.5 million rand, even below 3 million rand in some areas, high in demand, and that might cause the supply side to become more a normal market and even turn to a seller's market. So purchasers at the moment are really at a position to negotiate and also to enjoy possible capital growth in the next 6 to 8 months, just given the scenario where we will have a short of supply in that price bracket.
That ties up exactly what we've got on our side as well, Schalk. Yes. We also picked up, it's a lot of activity which is resulting in some specific areas a shortage of stock. And that's why it's very important to have an area specialist that you deal with, to have a trustworthy agent that can give you advice, good advice, firstly, and secondly, to be sure that that advice is backed up with research and with facts. It's pointless to listen to someone that just talks because it's talking. It's good to have someone that can give you the facts and statistics, which is very important nowadays. And that all just boils down to a very active market at the moment, which is great for us at the moment.
Jaco, I think a concern that one of the questions that we've had from one of our listeners tonight was market conditions with interest rates.
Yes.
Do we need to be alert or concerned about a interest rate hike in the foreseeable future, in the next 6 to 8 months, or let's call it even 2 years? What's your feedback from the banks on their forecast for increasing interest rates?
The banks, we've spoken to some banks that they forecast are that things will remain as is for the foreseeable year or so. Currently, the market condition cannot handle if we increase or if they increase the rates again. So it's basically, we suspect it's going to stay the same for the next year or two, and then gradually, if it increases, it won't increase with the same 1% or 0.5 as it's come down. It will slowly but surely increase with 0.25 over a year or 2 year period after a year or 2 years from now. So we don't expect them to jump up all of a sudden. And if they do, that means the market has improved considerably, and that means we can afford to pay it. So they always walk hand in hand, those two.
Then the next factor, Jaco, is your loan term. Just help our listeners with that.
Right, loan term, we traditionally apply over the 20-year term, as we've discussed earlier on, but we do have the options to stretch it a bit. Nedbank, for example, does up to 25 years. Absent Standard will do 30 years. Now, it is true you will pay a lot more interest if you do pay it off over 30 years, but to get your foot in the door, as you've said earlier on, Schalk, it's sometimes a good idea if you don't qualify over the 20 years, and just that extra bit of better property you can afford if you do it over 30 years, then we do suggest to clients to take a 30-year term, but then to pay it off quicker if they can. That is the most important part there. You can take the bond over 30 years, but you do not have to pay it off over 30 years. Traditionally, rule of thumb, it's about a 10% difference in installment between 30 and 20 years. That means if you have a bond over 30 years, your bond installment is 20,000 Rand per month, for argument's sake. If you pay 22, you will pay it off over 20 years, depending obviously on the amount. But you do not have to pay all those extra interests over 30 years. You can pay it off quicker.
Jaco, would the bond applicant, should they try to fix the interest rate on, does the loan term that remains on their current bond have an impact whether the bank will fix the rate or not? And also the interest rate will go with it?
Correct. The banks will look at the total portfolio of the client. They will look at how much time is still left on the bond. Is it brand new, or do you only have 5 years left on the bond, for argument's sake? They will look at all those factors when determining your fixed rate that they're going to offer you. That's why the banks were very reluctant when we did some research with them to give us a straight answer. We are fixing rates at this particular interest rate. All of the banks have come back and say, majority of them, and have said, every case, we've got our rules, but every case is assessed on its own merits. So yes, the remaining term should make a big difference because they've already made the interest out of you. If it's a 5-year left, for argument's sake. So it will definitely make a difference, yes.
And then the last one, Jaco, take us through the amortization period, what the thoughts on that?
That ties up with what I mentioned earlier on. If the client pays a lot more on his bonds. Now, traditionally, as I said, if you take the 30-year term, if you pay more into your bond, you pay it off a lot quicker because the extra funds that you pay into your bond, that goes off against your capital amount. So immediately it creates a snowball. If you pay more, then your installment will remain the same, your monthly installment, but immediately that installment is then higher than what you should be paying. And then the next month, the additional amount that you pay more is slightly more. Again, in the next month, also slightly more. So that creates a snowball, which means you will pay off your bond a lot quicker. If you just pay a small amount extra, as we say, it's traditionally about 10%, which will save you the difference between 30 and 20 years. So the more you pay into your bond, the quicker you will pay it off.
Jaco, take us through the views from the feedback that we've received from the 4 major banks. Let's start with Standard Bank. What was their feedback on the fixing the rate with current clients?
Right. Firstly, the client has to wait and for the bond to register to apply for a fixed rate, and that is across the board at all the banks. I've got to start off with that first. Unfortunately, we cannot do fixed rates up front anymore, like in the older days. The client has to wait for the bond to register. So, Standard Bank, the client has to contact the call center. The client, if he goes to a branch, that in any case going to refer the client to the call center. So the client contacts the call center. The call center will then call up the bond. They will do the discussion with the client, and they will then submit the fixed rate request through to the rates department. Now, Standard Bank mentioned to us, profile dependent on each individual client. They're currently offering between 1 and a 1-year term and a 3-year term that they will fix your interest rate. They've mentioned to us 1-year term, generally they're fixing at prime rate, which is a good offer, 7.25. And they've mentioned a 3-year term fixed rate of 8.25, not 1% above prime lending rate. But again, that's profile dependent on the clients. But they mentioned to us majority of the clients will receive those fixed rates from them.
Okay. Next is Nedbank.
Nedbank, there's no fixed specific fixed rate they will offer. That is entirely client's profile dependent. So again, also client has to contact Nedbank, the branch after registration. They will then look at the client's profile. They will see what variable rate has been offered by the pricing department. They will send it back to pricing, and then pricing will decide what fixed rate they will offer the client. What clients needs to keep in mind is there might be at some stage, if the client wants to cancel his fixed rate, let's say he fixes it for 5 years and he's 3 years into it and he wants to cancel his fixed rate, there might be a small penalty involved to the client by the bank. Again, we asked the question, what is, and they say they can't tell us. It is all, again, profile dependent. So Nedbank is very good with their rates at the moment, but fixed rates, it's all profile dependent by the client.
So no rates given to you in terms of what we can expect there?
Unfortunately not, no rates given, no.
Then Absa Bank, Jaco?
Absa, they've come back. They are the only bank that has mentioned to us that they will look at the client's variable rate and then just add a certain percentage on top of that, which makes a lot of sense because they've already assessed the client's risk profile when they assess the application, when they offer the variable rate to the client. So on that level, they add a certain percentage on top of the client's variable rates. I've spoken to them, and one of the clients were recently offered 0.14 percentage points above his variable rate for a 1-year term, which is also a very favorable rate, if you ask me. So also, again, it's client profile dependent, that they will offer the percentage above the client's variable rates as the fixed rate.
So Jaco, what you're saying here is the bond application is as normal. You submit the documents to you submit to the bank, whether it's an Absa Bank client or Standard Bank client, you submit the application with all the banks, and you, let's say for argument's sake, you get a response from the application by a prime plus 0.5, so the interest rate on the client's bond will be 7.75% in the current market. Then the bank will take that and consider the fixed rate. Is that right? Do we understand that correctly?
That's correct. That was on Absa side. That's correct. Yes. That's officially. The other banks will also look at it when they assess the client's rate. They will keep it in mind. But Absa, with the bank that confirmed to us, they will look at the variable rate plus then a certain percentage above the variable rate. Yes.
Okay. And we did say that we're looking at between 1 and 5 years. That is what the banks are prepared to fix at this stage.
That's correct. That's correct. Yes. What we also need to keep in mind on Absa's side in particular is if the client currently has a bond with Absa and he wants to fix his existing bond with them, very important to note, the moment you fix your rates with Absa, your flexi reserve or your access facility that you have with Absa will be frozen. So it's important. Lots of clients uses those funds for holiday funds or for the business or whatever as a contingency fund. To keep in mind, the moment you fix your rates, your flexi reserve will be frozen. So that's important to keep in mind as well. They've also mentioned to us, which makes logical sense, but if a client wants to fix his rate at the branch or at the bank, his home loan is not allowed to be in arrears. It needs to be good conduct of account. If it's not a good conduct of the account, if the home loan is in arrears, they're not going to fix the rate for the client. Just to keep that in mind as well.
Great. Then the last bank, FNB, we have had no feedback from, so we assume it's the same. Once you have got your bond application approved, after registration, to submit directly to the bank to see what they will be offering you. So unfortunately, they did not come back to us with any indication whether they will look at 1, 3, or 5 years, and also no indication of what the interest rate could be. So from looking at this, and obviously you giving us some feedback, Jaco, it's clear that it all boils down to affordability. And yes, the determining factor must be affordability and the goal that you have in mind by fixing your interest rate. Is it to manage your risk, or is it whether you have the uncertainty about any future event that might be happening? I think this is what it all boils down to, and Jaco is available should you have to have the discussion to just see, given your circumstances, what you could potentially expect from the banks. So this decision is a big decision. It is possibly a good thing to do it in the current market, but understanding what the outcome or the goal of fixing your interest rate, and also knowing that you will be paying slightly more than the current prime interest rate of 7.25%. Also, looking at all historical resources and sources that we've gone through, we can probably say that you will most probably be paying less on your variable interest rate than with a fixed interest rate. That is from what we got back from all our sources, looking at the past, but you can't always use the past to determine the future. But once again, should your circumstances be uncertain and you would like to have at least clarity or certainty for the next 1, 3 to 5 years, that's definitely an option. And what I've just heard from Jaco is looking at a prime rate plus 0.15 to 1%, roughly, to what to expect in terms of what your interest rate will be. So thank you for that, Jaco. Leading into the next frequently asked questions, I think you've answered most of these questions. You did mention that the client need to phone the bank on registration and to see what rate will be offered. So we can't do that during the application process or before the property is transferred. You did say that clients that want to fix can't be in arrears with their bond installments. He also did mention that on the set period when it expires, the 1, 3, or 5 years, your interest rate goes back to the variable rate, which was quite clear in your feedback. We did mention it's between 1 to 5 years, with 5 years being the maximum. We've also seen, Jaco, this one's actually quite interesting, that if we enjoy a further interest rate drop, which we do expect, it seems like they're talking about a 0.25, 0.5% further drop later this year. Unfortunately, you as the consumer, customer, will continue to pay the amount that you fix it at. So it will not work in your benefit if it is adjusted down, which is something to bear in mind, given where we are currently with the downward trend of our interest rates. Jaco, you did mention this. This is very important. Your flexi facility falls away with a fixed rate. Please discuss this with Jaco or with anyone before you do obviously do this. And Jaco, you did mention this as well. There could be a cost if you cancel the fixed rate before maturity. Good. So going forward, we are, as always, here to help you. We are more than happy to help you with determining your credit profile. We do this free of charge. If you get in touch with us, we can help you to give you an idea of what your credit profile look like and what you can do to improve your credit profile. We're also here to help you with pre-qualification. Most important, not to start your home hunting journey before you have done this, because there's nothing worse than being excited about the right property, the right investment, and not having your finances in order. Jaco is available for this, and he can help you with this also free of charge to help you to pre-qualify and know what you can afford. Should you be registering a second bond, we also help you with that, taking all factors in consideration. So you can contact us for that as well. And then lastly, should you want to leverage or access equity on your existing property or properties or your portfolio, we're also there to help you with that, should you need that to further investment or need that for cash flow purposes. For tonight, thank you for everyone who joined in. Thank you for listening. And as I say, we're here to help you make good decisions. It is probably the biggest decision you'll ever make, and we're here to help you to make sure you do this with all the information needed. Knowledge is power, and we would like to put that in your hands. Before we end tonight, maybe Roger, were there any questions tonight that we can answer, or are we going to close the webinar now?
Schalk, yeah, there were a few questions which Jaco pretty much answered through the webinar. There was just one that kind of stands out. Gavin, who is a first-time buyer, he's asking, if you bank with a certain bank, would that bank give you a better deal than the other banks? And is it still necessary to go through a bond originator? What are your views on that?
Definitely not. We've found that more and more these days where the banks, unfortunately, count on that loyalty factor, where they feel, right, you've come straight onto us, you didn't approach an originator, you came straight into the branch, so they're going to give you the average rates. Whereas if we submit an application from our side, the banks are aware that we multi-submit to all 4 of the major banks, which means they've got to sharpen their pencil for us because they know they're up against the other banks. And we've got such a good relationship with all the pricing officials at all the 4 major banks, where if we get a better interest rate, we're never going to tell the client if we get from bank A an interest rate and the client banks with bank B, we're never going to say, take bank A, let's go on with it. We're always going to go back to the client's own bank with the best interest rate from all the other banks, and then get his own bank to match or beat that offer for us. If they do not want to do that, then obviously we'll discuss it with the client and we look at other variables. But to answer the question, it's very seldom where your own bank gives you the best interest rate first time rounds. We get a lot of better rates from other banks at the moment.
Okay, great. That's it for this evening then.
Great. Perfect. Thank you very much, and happy house hunting.
Great. Thank you.